Good morning, everyone. Welcome to this update for global stocks and commodities for the 10th of February. There is so many negative things going on around the world at the moment that it really is very easy to take that particular stance. And of course, the media plays into that perfectly because that's what sells stories, is focusing on the negative and trying to engender some fear in the population. And if you look around, I mean, economically, Europe has stalled and could easily fall into recession. In fact, Italy is already in recession. We've got Japanese manufacturing slowing. We've got obviously China has been well documented in terms of their growth rate weakening and some of their debt issues. We're seeing India, which has been a really strong growth area, is starting to come off the boil a little bit. We've got global trade frictions. We've got Brexit. We've got a US government shutdown. So there's just so many things that people are wringing their hands about. But you know what? The fundamentals, and I'm talking about America here, the fundamentals and the valuation are positive enough for stocks in general to hold up. And that's certainly being borne out in the current earnings season. And the best growth stocks are that you've purchased on good terms are going to do very well. So that's the bottom line, and you've got to try and shut out all the rest of the noise. You know, there are good opportunities out there, and things in the US. And the US, let's face it, sets the tone for global stock markets. They may not all proceed in the same direction, but at least if the US market is positive, then that's a good thing for the rest of the world. And at the moment, what's going on in America is good enough for stocks to hold their ground and the better stocks to go up. So I think that's the really, really strong message that I want to get across today. And I'm always on the lookout for companies that are raising their outlook guidance, particularly in the States, because they seem to be a bit clearer and it's better reported than it is in Australia. So I'm always looking around for companies that are raising guidance, particularly in this sort of environment, because CEOs don't need to. They don't need to raise guidance if they just held guidance where the expectations are. But if they raise guidance, it means they're exceedingly positive or exceedingly confident about where their business is going. So really, at the end of the day, there's a lot of noise out there, but it's all about earnings. That's the bottom line. It's always just about earnings. So for this update, there's so much that could go wrong, but US stocks, the earnings season is going well. Stocks are tracking earnings, and that's it. That's all that matters. We'll look at the normal stock and commodity updates. And in Portfolio Analyst last week, I went through the major Australian gold producers, looking for opportunities there. And also, I'm just in a process now of rolling out, just bit by bit, really, really strong opportunities in American mega cap stocks, which I think is the smart way to be playing America at the moment. So let's have a look at the week. The S&P was flat, or it might have gained a point, but essentially flat on the week. And what is obvious, though, is that during the last quarter of last year, the market sold off at the end of the session into any rallies. That is now, and that happened just session after session after session. That has now shifted back, and the sentiment has now shifted back to buying the dips. And we're seeing any little dips in the latter half of the trading session, seeing some good buying coming in to counteract those little bits of downward movement. So definitely a sentiment shift in the US. We're now at a critical technical level, as you'll see, at the 200-day moving average, and the market did pull back from that during last week. But you've got to say that the energy is to the upside. So I'm seeing this last little bit as being, not much more than a bit of an overdue pause, and we certainly are overdue for a bit of a pause and a bit of a pullback, but that's just normal. 2 steps forward, 1 step back is the way that things progress. So the US dollar also rebounded during the week quite strongly, and the 10-year Treasury yield is now down to 2.63. I mean, who would believe that? You've only got to go back about 4 or 5 months, and the Treasury yield had broken through 3%, gone up to 3.25. Everyone was convinced it was going to 4%. The Fed was going to keep raising rates, and the stock market was in trouble. And that really is what started the correction in October. And it only lasted a couple of weeks. And now we've come right off the boil. And amazingly, the US Treasury, 10-year Treasury yield was at its lowest close in 12 months. I mean, that just is inconceivable to where we were 3 or 4 months ago. So it just shows you that you shouldn't ever lock in a position as a given. So let's jump in and take a look at some of the charts. And we'll start with the S&P. And you can see an incredible sell-off that started in December. So that was really about Jeremy Powell comments from the Fed. Culminated in a huge capitulation on just before Christmas, and then it's just all turned around like this part here should never have happened. And it probably shouldn't, really. The data hasn't changed all that much. So this whole part here should never have occurred. A lot of it was just exacerbated by computer algorithms. So if you ignore all this bit, then we've come off the boil a bit. We've gone into a big sideways movement. And you can see we ran up to the 200-day moving average, the red line, and we pulled back in the last couple of days. But the momentum is definitely to the upside. Now, I'm not saying that we're going to go straight back up here to new all-time highs, but I certainly think that new all-time highs in 2019 are a possibility. But irrespective of what the general index does, everybody really shouldn't be trading the general index. They should be looking for individual opportunities for really good stocks that get oversold. I mean, that's really the name of the game. And those opportunities do present themselves. And down here, there were some amazing opportunities in some of the world's biggest and best companies that we were able to wrap our arms around. So it's been a very, very good rebound. And if we look at the small cap end of the market, not quite as steep with the Russell, and particularly of late. But nevertheless, small caps have bounced back pretty nicely as well. US dollar index, higher, as you can see, during that week. And we're getting a bit of a big, broad consolidation period here. But the overall momentum is still to the upside, as it should be, because the US economy is going better than just about any other economy in the world. So every reason that the US dollar should be tracking higher. Let's move, just before I do that, let's just look at the Treasury yield. So the 10-year, which is obviously pretty critical. If you don't know much about the bond market and you wonder why I focus on the bond market, well, the bond market sets the risk-free rate for the world, and that is in part how stocks are priced. So it's vital to be watching these sort of indicators, and you can see that we had a breakout that looked like it was going to lead a charge up to 4%, and now here we are. We're back at the same level that we were at in December of 2016 and January of 2017. So quite an amazing turnaround. The Aussie dollar sharply lower to under 71 cents in the finish, got down to about 70.5 at one stage. And it's finally the RBA's come out of their denial that the Australian economy was strong and the next interest rate rise was going to be to the upside, with the housing market and the Royal Commission and commodity prices. You know, there was no way that the Australian economy was going to stand up to all of that, and interest rates were going to go up. So RBA has now changed their language quite dramatically, and the Australian dollar has sold off and is now getting down towards the bottom of that range. Our index strongly higher by 208 points. That's one of the biggest weeks we've seen in quite some time, and that was on the back of a big bounce in the banks. And I've said as the banks escape. Now, I know there's been a lot of media coverage on, how bad this is for the banks, but really it could have been, so much worse. And the disappointing thing out of the Royal Commission report is that there's really no structural change for the industry. There's no big things that are going to culturally change the way the finance sector in Australia works. Yes, there's going to be penalties, certainly monetary penalties, and possibly even criminal penalties. But that doesn't change the basics that the Australian finance system really has some very deep flaws, and none of those have really been addressed. So it's been a terrific show, the Royal Commission, but it hasn't really produced what a lot of people were calling for. And also too, there was some heavy buying of bank shares in the few hours before the Royal Commission report came out. And if that's not investigated, then it's an absolute shambles, because obviously some people made a great deal of money out of that bounce back in the banks because the Royal Commission report was a bit soft. Now, you could argue that some people were just smart and anticipated the move, or they got lucky, but I'm sceptical. Now, reporting season has started in Australia as well, and there's a bit of a negative bias on the outlooks in particular. And I did see a number through the week that said, and I can't validate this myself, but I'll just report it as it was, that the negative outlooks compared to the positive outlooks are running 5-1 in Australia. So in other words, for every one company that's improving its outlook, there are 5 companies that are downgrading their outlook. That doesn't necessarily mean they're saying their earnings are going to drop. It just means that they're now winding back the previous guidance that they'd given to the market. So there's definitely a negative bias around the Australian market at the moment, that's for sure. So let's just take a look at the Australian charts. So there's the ASX 200, jumped up from around 58.50 and finished at 6,071 points. The big gainer was the banks, particularly the day that the Royal Commission report came out. We also had some strength in the major miners as well, although that did peter out on Friday when we reached a double top up there. So that's the Australian market, the Australian dollar. So we're now back down into the lower quadrant of this trading range that we've been in for some time, which is really between 70 and 73 and a half. And you'd have to say that the likelihood is that if you had to have a bet, toss a coin, the Australian dollar should break this consolidation zone, should break it to the downside. So I think the long-term expectation is quite realistic for the Australian dollar to be somewhere between 65 and 70 at some stage over the next year or two. Precious metals, gold dropped a little bit to 13.15, but the momentum is definitely upwards in gold. I think the overall odds favour a long-term upswing, but I'm certainly talking long-term, as in think 2, 3, 4 years. But you really need to think about, rather than just jumping in and taking a position in gold and assuming that it's just going to go straight up, I think you've got to be a little bit cleverer than that. And gold is a volatile sector, so use the volatility to advantages. Buy gold stocks when they're oversold or at the bottom of the range. Don't just buy them because the money is burning a hole in your pocket and you want to get some Australian gold stocks. That's not the way to go about it. Identify the targets, identify the best companies with the most robust and reliable of growth, and have a bit of an idea of what price you'd like to get into them at, and just wait for it. And if it doesn't come, well, you've quite possibly have saved yourself some money. Precious metal stocks, GDX is mildly leading the metal. It's not a really robust lead like we saw in 2016, but that can always pick up momentum. But the good thing is that stocks are looking better than the actual metal itself. So if we look at the gold price, that's the gold price on a daily basis, definitely working its way higher, higher highs, higher lows, brief little consolidation. We're well above the 200-day moving average and the 50-day, which is the blue line. There was every reason that the gold price could have pulled back to a lower technical level, perhaps somewhere down around the 1250, 1260 mark. It didn't. It managed to hold its ground and then fairly quickly pushed on. So there's no question that the momentum is to the upside. And if we look on a weekly chart, we've just got to get ourselves above this 1380 level, and then I think you might see some concerted technical buying really come into gold. But we're not there yet. GDX, definitely an uptrend. GDX has moved from the low $18 mark. We're now at 22.34. So it's been about a $4 move, which is about 20%, between 20 and 25% move in GDX. Doesn't look a lot on the chart, but that's still a pretty decent move. And that's all occurred basically in the last 6 months. Other commodities, copper was up to 2.81 and showing a bit of strength despite the fact that the US dollar went up. So that's impressive considering all the global growth concerns. So I think the futures market may be doing a little bit of a contrarian dance here. When things looked as though the copper price really should go down, it tends to head back up again. West Texas Intermediate crude fell from 55.5 down to 52.7, and it's really just about fluctuations in inventory and sanctions on Venezuela at the moment, which is reducing the global supply. So those sort of things fluctuating backwards and forwards. The energy sector pretty unpredictable at the moment. There's the spot copper chart. In fact, we actually got to about 2.83 during the week. There's the 1 year LME copper warehouse levels, ticked up just a little, but still pretty low, still close to 5-year lows. Crude oil on a 3-month basis just pulled back a little bit into that consolidation zone after that little false breakout. So there's a little false breakout just around here when we managed to get above all these peaks. We've pulled back, and that's it on a yearly chart, just to give you a bit better perspective about just how volatile oil has been. If you go back to 2016, we were trading down around $30. Then we went to 75, and just when it looked like we were going to 90, we came back to 45. So it really has been incredibly volatile. Wrapping it all up, earnings are the key driver of prices. Really, that's it. You don't really need to look much further than long-term earnings. You've just got to forget all the other stuff. All the things I talked about at the start about the US government shutdown and global trade frictions and Brexit and all those things that everybody wraps them all up in their mind and assumes that it's got to be negative for stocks. It's really all about earnings, and in America, the economy is good enough, the earnings are good enough, and I believe that we're going to see the S&P either trade around this level or higher, work its way higher over time. But the best stocks that have been accumulated in a smart manner will do very well. Overall, you should have a bit of a contrarian bias to your thinking. Don't get too bullish when the market rallies, and don't get too bearish when the market goes down. You want to be thinking about, taking the trade in the opposite direction. But don't just be a contrarian for the sake of it. You almost always need to wait until you actually see the reversal that confirms that, maybe everything is just so bad that now it can only really go upwards and get better. Be patient with your plan if you've got one. Allow it to play out, because sometimes these things can take 6 months to play out. And if you're looking at things on a day-to-day or week-to-week basis, it's just too short a time frame to expect things to work in your favour. So be patient with your plan. Portfolio analyst this week. This sort of volatility creates opportunities. So there's not that many opportunities right now because we've just had a terrific 5 or 6 week rally. So I'm looking for the next wave of opportunities. So I know what the stocks are, and I'm formulating a broad idea of what I think would be an attractive technical entry. So that's the rundown for this week. There's my contact details for anyone who is not a member of Specialist Share Education, and we'll see what the week coming brings. Cheers.